Benjamin Graham, often called the father of value investing, built his career around one central truth. Successful investing is not about chasing profits, it's about managing risk. His teachings shaped generations of investors, including Warren Buffett, who once said that reading Graham's work changed his life. In this video, we'll explore Graham's timeless philosophy on risk management, principles that remain just as relevant in today's fast-moving markets as they were nearly a century ago. Graham understood that markets can be cruelly unpredictable. Investors who entered the roaring 1920s confident in endless gains were devastated by the crash of 1929. Fortunes built over decades vanished in weeks, not because people lacked intelligence, but because they lacked discipline in managing risk. For Graham, risk management wasn't optional. It was the foundation of survival and long-term success in the market. At the heart of Graham's philosophy lies the concept of the margin of safety. He argued that investors should never pay full price for an investment. Instead, they should purchase well below intrinsic value, leaving a cushion for error, uncertainty, and unforeseen events. He compared this to building a bridge strong enough to hold 30 tons, but driving only 10 tons across it. The gap between capacity and usage is the safety margin. For Graham, this margin transformed uncertainty into opportunity. It meant that even if mistakes were made or the market turned against you, the damage would be limited. Another central theme in Graham's philosophy was the clear distinction between investors and speculators. Speculators chase excitement, tips, and market trends. They are driven by hope, fear, and the constant noise of the ticker. Investors, by contrast, focus on facts. They study balance sheets, earnings power, and the true value of businesses. For Graham, the danger of speculation was not just losing money. It was that speculation often works in the short term, which misleads people into believing they're skilled, when in reality, they are merely lucky. His warning was simple. Risk is not defined by market volatility. True risk lies in the possibility of permanent capital loss. Even the most skilled analysts make mistakes. Graham himself admitted this, which is why he stressed diversification. Diversification, he argued, is a shield against ignorance and uncertainty. By spreading investments across a range of carefully chosen opportunities, no single failure can destroy a portfolio. But Graham was careful to point out that diversification does not mean buying dozens of random stocks. It means thoughtful balance, building a sturdy ship where each plank reinforces the others. Perhaps Graham's most profound insight was that the greatest enemy of the investor is not the market. It is the investor's own emotions. When prices rise, greed whispers to buy more. When prices fall, fear screams to sell everything. This cycle leads many investors to do exactly the wrong thing at the wrong time. Graham encouraged investors to see the market not as a master, but as a servant, what he famously called Mr. Market. Every day, this servant offers prices. Sometimes they are rational, other times wildly emotional. The intelligent investor uses Mr. Market's moods to his advantage, but never takes orders from him. One of Graham's most overlooked lessons was the importance of knowing exactly what you need from your investments. If your financial security requires a modest 5% annual return, why take reckless risks chasing 20%? Graham argued that clarity of purpose reduces unnecessary risk. By setting realistic goals, investors avoid the temptations of greed and instead focus on consistent, sustainable returns. For him, true wealth was not about hitting home runs. It was about avoiding strikeouts. Together, Graham's principles form a complete framework for risk management. Always demand a margin of safety, separate investing from speculation, diversify intelligently, control your emotion, define your return requirements. When applied, these practices don't just preserve capital, they build the foundation for long-term compounding and steady growth. In Graham's view, the market will always fluctuate. There will always be booms and busts. But investors who follow these principles can endure those cycles and even use them to their advantage. As he famously put it, the intelligent investor is a realist who sells to optimists and buys from pessimists. Nearly a century later, Benjamin Graham's philosophy on risk management continues to guide investors worldwide, reminding us that true success in the market is not about predicting the future, but about preparing for it. Take 2020. The pandemic hit, and companies like Disney, Microsoft, and Starbucks dropped 30% or more, not because they suddenly became bad businesses, but because fear took over. Graham would have called that clearance shopping season. Then look at 2021. GameStop and AMC skyrocketed far beyond any reasonable valuation. Graham would have said, "This is the moment to sell because the price and the value no longer match." His philosophy gives investors a compass in a world where everyone else is just reacting to headlines. What makes Graham timeless isn't that he found some magic formula. It's that he gave investors a way to stay rational when everyone else is emotional. Instead of chasing the latest trend, you become a detective, analyzing, calculating, and patiently waiting for the right opportunities. It's not glamorous. It's not a get-rich-quick scheme, but it builds wealth steadily, and it protects you from devastating mistakes. Warren Buffett, Graham's most famous student, summed it up best when he said, "The market is there to serve you, not instruct you." That's Benjamin Graham's DNA running through everyone. So, the next time markets drop and everyone's panicking, remember Benjamin Graham's wisdom. Buy low when the value is real, sell high when the price is stretched, and always demand that margin of safety. That's not just a slogan, it's a mindset. It's discipline over emotion. It's patience over panic. And it's why Benjamin Graham's philosophy continues to shape smart investors almost a century later. Thanks for watching. If you found this breakdown helpful, hit that like button, subscribe for more investing wisdom, and drop a comment below. Do you think Graham's buy low, sell high philosophy can still beat the market in today's world of hype and volatility?